Hola a todos, me llamo María Gómez Silva y les saludo desde el estudio de la revista Inversión y Finanzas.com. En el podcast de hoy vamos a hablar sobre los fondos de retorno absoluto. Ya saben, esos productos que están destinados a obtener retornos positivos sin importar el entorno de mercado. Para hablar de ello tenemos hoy un especialista en la materia. Se trata de Andy Warwick, que está de paso por Madrid para hablar de su fondo BNY Mellon Global Real Return Fund. Hello Andy, thank you for joining me today.
Thank you for inviting me.
Can you explain to our viewers what absolute returns funds are and specifically what's the strategy of your product?
Okay, so we are a long-only multi-asset fund, but rather than having a benchmark to an equity index, it's about generating an absolute return for clients. So we're trying to generate a return of cash plus 4 over a cycle, and we always put an emphasis on capital preservation. Sometimes clients, particularly recent experiences like, why do I need that? Well, then we see days like August the 5th this year or times of COVID when markets become very volatile and unstable, and our fund can actually preserve capital and dampen the volatility. That's really what it's designed to do. So it's a long-only, purely multi-asset fund. So it's not a balanced fund. It trades in all sorts of different asset classes: commodities, alternatives, equities, bonds, risk premium, etc. And our idea is to try and find the best source of returns that are consistent over the long term for our clients, but also make sure that we can preserve capital when markets become unstable.
The Real Return Fund had its 20th anniversary last year, having carved out a reputation as one of the biggest and best regarded absolute return teams in the UK. However, its performance has been a little bit disappointing recently. Can you summarize the performance of the fund?
Yeah, well, firstly, the 20th anniversary was this year. So we had a get-together for that. So that's 20 years, which was seen quite a lot of interesting things. Great financial crisis, the European issues, of course, COVID, and now the recent election. And actually, performance has been has outperformed over that period. There are always going to be periods where the fund underperforms. We'd love to be able to do cash plus 4 every year. We can't do that. So 2019, 2020, 21, we were way ahead of our return target. 2022 was a very challenging year for us and for everybody. In fact, if you think about 2022, the only asset that really worked for you was the US dollar. Equities went down, bonds went down, credit went down, the Japanese yen went down, equity volatility didn't work. So nothing worked apart from the US dollar. And it was the very first time in 20 years that the fund had a negative return in a calendar year. But performance recently, actually the past year performance is up over 13%. So again, we're back into that, generating those excess returns over the benchmark. And that's been characteristic of the fund for 20 years. As I say, there are some periods where we can really make hay, and there are other years where it's very difficult. 2018 was a very difficult year for many people. The fund was flat on that year, where a lot of people were down 7, 8, 9, 10%. So again, it's about preserving capital when you need to, and when the market is in rude health, that's when you can generate the returns.
But outflows have been severe in the whole category, not only in your fund. Why should investors return to these kind of funds? Capital preservation, as you said?
Actually, it's a good question. So I think the whole category has suffered. The category really took in huge amounts of assets post the great financial crisis because a lot of these funds did well, not just us. We were up 6% that year in 2008 when the markets were down 40%, and that saw huge amounts of inflows. And then the irony was for the next 10 years, that with the amount of sort of what I call financial repression from central banks, interest rates at zero, negative in Europe, as you know, all you needed in hindsight was to buy cheap beta. You just needed some equity beta and a bit of duration. That regime is over. We are now in a new regime, and 2022 was a transition year. They're very uncomfortable years, as I said earlier. Nothing works. But we're now in a new regime that you can't rely on bonds, for example, to be your risk hedge. Right? They've got their own risk. In fact, they're adding more risk now than equities are. So this is exactly the period. This new regime we're in, which I think we'll be in for a decade or more, is about being really dynamic, about understanding at which part of the cycle you're in and can I own bonds, or should I own gold, or how should I protect my portfolio? Should I own Chinese equities here, or should I just stick with US equities? So it's the days of just buying cheap beta. That was the previous decade, and none of our funds can compete in that, because we're competing against the cheapest in class. I think the past couple of years, and this year again is no exception, is a year that says this is why we need a fund like this, because we need to manage these. It's going to be crazy volatility, right? We've been used to this world of low vol, slow economic cycles that expand forever. This is going to be crazy vol. And August the 5th, we saw this mad day ever, right? The biggest one-day move in the VIX, the biggest move in the Nikkei since '87, on the back of what? A 25 basis point move in Japanese interest rates. Fortunately, it was short-lived, but I think we're going to get more and more of those as we go through this decade, and you're just going to need to have to be very dynamic and respect that.
In this new regime that you have mentioned, where do you find opportunities in fixed income? You have 30% of your portfolio in fixed income.
Yeah, so I think fixed income, you've got to be very tactical, right? This is not... I think the previous decade, you could just buy and hold fixed income. It gave you great returns because yields kept falling, right? We're unlikely to, I think, in our lifetime, see the US 10-year yield at 0.5%. Those days are gone, right? And so we're going to have much more volatility of yields. And in fact, if we're right about this, I'm doing a presentation called Back to the Future, and it ultimately is about what we're going to see in the future is actually stuff that we've seen in the past, but pre the great financial crisis. And so I think we're going to see more inflation. It's going to be stickier inflation. We're going to see the central banks having less control over inflation, and so monetary policy is going to become less effective. And that means that ultimately this ends up with a proper yield curve, as we used to have when I had hair, in the old days, which is absolutely right. I should be compensated for holding 30-year bonds as opposed to 2-year. You should have to pay me more as an issuer, and we're going to have that. What that means is ultimately the yield curve's going to push higher, yields themselves are going to push higher. That's not a bond-friendly environment for a buy and hold. So if you're going to trade bonds, you need an active manager. And I would say you want an absolute return manager, and somebody's not tied to a benchmark, but somebody's free to go wherever and can find the best places, whether it be credit or high yield or government bonds, EM debt, etc. But yeah, you need to be much more dynamic on this stuff, because you saw the losses in 2022 for these bond holdings, right? It just crushed people.
I've seen that you own Spanish government debt. Do you think that there is an opportunity in Spanish govies?
I knew you'd get excited about that. It's very short-term stuff, so it's less than a year maturity. We're really just paying it. There is a nice pickup over other European bonds in holding Spanish govies. So it's not a play on our long-term view of Spanish debt at all. It's much more about with the shorter-term pickup, if you like. So sorry to disappoint.
Apart from the fixed income, around 40% of your portfolio is invested in stocks. What companies do you own, and why do you like them?
Well, it should be no surprise if I said, what our top 10 holdings would be. You'd probably guess at least half of them. So we own, things like Amazon, Nvidia, Apple. They're all in our fact sheet as our top 10 holdings. We like them because ultimately these companies are best in class. They have the best IP. They're cash cows. They're just generating, and they have, if you like, the most sort of thought-leading people working there. If you think about AI, our view is that AI is a proper generational change in theme, a bit like the internet was. It's not going to happen overnight. It's going to take years for other companies outside to adopt it, and for it to change the way that they actually do business. But it is exciting. So it is a lot of those things. I would say at least half our equities are US equities. US supremacy still here. The election victory is going to spur that on even more now, because if President Trump follows his agenda, which is to cut corporate taxes, those companies in America are going to benefit, of course. And we're bottom-up stock security specialists, so there were definitely opportunities in Europe. But I think as a whole, you've got to be much more thoughtful on picking those individual names that you think are going to be long-term winners.
Mm-hmm. You have said so that your fund is mainly a long-only strategy, but as you have some allocation to derivative contracts to limit volatility. Can you explain how do you use derivatives as a defensive measure in this new era that you have mentioned?
Yeah, so we use derivatives for many different things, but primarily as a hedging. Derivatives are financial derivatives are fantastic tools to be able to change the risk profile of your fund instantly. So if I think I want to take down equity risk, or I want to add duration, or change my currency risk, I can do it with derivatives in a couple of minutes. I can change even a portfolio as big as ours. I can reshape that portfolio because derivatives are very liquid. And they're very, very cheap to do that. So what it means is I can get to the risk profile I want, and then I can gradually work my way through physical assets. So a great example would be something like we had a very low equity weighting at the end of the third quarter last year, around about 20%. We tripled it within a month, right, to 60%. All the way just through derivatives. And then as liquidity came on board, as the market started to buoy higher, we could do the work and buy the equities and add the single stocks and sell the derivatives. So in other words, I got to my risk level I wanted, and now I get the actual assets I want. They're very, very efficient to do that. They're wonderful tools. And as I say, they're very, very cheap to do. And you can just, as a portfolio construction measure, they make such sense to shape the risk that you want as a PM instantly.
Mm-hmm. Well, it was a pleasure to have you, Andy. Thank you for your time and have a nice flight back home.
Thank you very much.
Y a ustedes, gracias por estar ahí. Recuerden que pueden seguir la actualidad de los mercados en la revista Inversión y en finanzas.com. Hasta pronto.